and of course, when you talk about insolvency, talking about liquidation as well, is from several viewpoints. First viewpoint is while discharging your duties as an insolvency professional, you would be facing questions of how to treat income tax claims. There are a variety of ways in which tax officers have started reacting to some of the recent rulings, as they also get more articulated in understanding of the law, particularly the rulings. They've started coming in various ways. For instance, you would find tax officers are now seeking priority at par with secured creditors. They say that we also, and they cite Supreme Court rulings to say that we are also secured creditors, and therefore our claim ranks at par with secured creditors. Obviously enough, there is no security interest registered in favor of income tax department. So how to deal with tax claims? If the tax officer says I'm a secured creditor, you would probably see that there are rulings of Supreme Court. You would see that there are perhaps rulings of NCLAT as well. That's one part. Second part, quite often you would also see during the resolution proceedings when moratorium is already going on, there would be things like, let's say, an appeal process coming. There might probably be a demand coming. There might probably be an assessment proceeding coming, etc. So does the moratorium imply there's a complete standstill as regards income tax proceedings as well? That's another question that insolvency professionals face. And a third and even a more tricky question is that if you have a refund due to the corporate debtor for a particular year and you have a demand relating to a previous year, as a matter of almost an automated process, it's an automated thing. There's nothing that anybody is doing manually. There would probably be an automated process whereby the demand would get adjusted against the refund due to you. For instance, you have a refund due to you, let's say for your, let's say 2021, which is, or let's say 21-22 for that matter, there's a previous demand pertaining to an earlier year. The refund would automatically get adjusted because you will not get the refund. You will get a notice saying your refund has been adjusted against an outstanding demand. As insolvency professionals, our first question there would be, if the refund due to a corporate debtor could be adjusted against pending demands, then what happens to the priorities under Section 53? There was one amount which is receivable, there's an amount payable. If the amount payable has been adjusted against the amount receivable, then the amount payable has got first priority without even forming a part of the resolution process or for that matter liquidation process. The amount gets automatically adjusted. So these are substantive questions relating to the rights of tax officers. Then comes the issues pertaining to preparation of resolution plans. Many of us are required to advise and assist resolution applicants as well. And therefore the question comes, what will be the position of the eligibility to claim set off for carried forward losses? Obviously enough, you're talking about insolvent entity, and therefore there would be a pile of deferred tax assets there. And deferred tax assets have substantial value. And the question is, what about those assets? Can the assets still be available to the corporate debtor once the resolution process is complete? That is, can the resolution applicant claim benefit of those brought forward losses from the past? There's even a more tricky question about what happens to the write back of liabilities. Every resolution entails a significant write back. Write back in the sense the claims due to financial creditors are written back. Even more steep will be the write back of claims of operational creditors. These very claims which are due to operational creditors would at some stage have been claimed as expenses. I'm sure you can all relate to it, that operational claims essentially arise because there was a debit to an expenditure at some stage. It might be a purchase of goods, it might be a availing of services. There was an expense claimed at some stage, and therefore there was a liability created towards an operational creditor. When the liability is written back, are we inviting the provisions of income tax law which result into a credit to an income, and income has to be deemed, notional income is deemed when you write back a liability which originally arose by claiming an expense, which is what is called trading liability. That brings us to a significant question of what about the taxability of those liabilities. And I'm sure all of you would agree that every single resolution plan entails a write back of operational creditors as well. So the question of taxability of those liabilities also comes in. Some of these issues have been resolved by specific provisions of the statute, but that's only for some issues. Sure enough, not all the issues that arise during resolution can be handled by specific provisions of statute. And it would be a long road for jurisprudence to develop, because development of jurisprudence would mean there is a decision by the first appeal authority, then there's a decision by the ITAT, then probably the matter might go to high courts, and eventually there might be Supreme Court ruling. We're talking about a time frame of nearly about 10 years before matters get settled. So in the meantime, you would probably have done your resolution, the RA would have hopefully carried whatever resolution was to be carried, and so on. So these issues remain unresolved, and I don't know whether we have answers to these complicated questions. We have complicated questions for sure. So what we are doing, myself and my colleague Shikha, will be raising a lot of questions, and I'm not sure whether we have answers to the questions. So our success lies in raising questions, not in giving answers. However, for whatever we can do in terms of engaging you all in trying to get answers to nagging questions, that's what we hope to do today. I can see that we have over 200 participants already, and I think all of you, as I can see several names which are very familiar, all of you are people from practice. You have significant experience yourself. So please do not hesitate giving us the benefit of your wisdom, your expertise on the subject, by letting us all get the benefit of your experience and your views as well. While we begin the session, and the way we'll do will be sort of toggling between myself and my colleague Shikha. We'll keep sharing the presentation as we go. My request to all of you, I think I can see constantly messages coming on chat board with your registration numbers. I think that's probably serving as a matter of record that you are there. Unfortunately, we will not be able to take note of the registration numbers for CP hours. That would be left to ICSI IPA to do. But
yes, sir, if I could interrupt for a minute.
Please.
I would request all the participants to not put their details in the chat box. We will get a list of everybody who has joined and who has registered at the end of the session. There is no need to put the registration number in the chat box. We will take it into consideration as per your registration details that you filled in while you were registering for this webinar.
Maybe there might be negative marking for those who are writing the registration numbers in chat board. So please do leave the chat board for questions on the session or for use on the matter instead of writing your registration numbers. And thanks messages which have now started coming on the chat board, but let's keep the chat board for more substantive discussion. My request is we can probably intermittently we can have Q&A sessions. We can probably have time windows dedicated to discussion with you all. But in the meantime, let's first begin. And Shikha, maybe I think you can start by initiating what are the topics we're going to cover today. And then maybe you can start with this one to just give an idea of what all we're going to do. And then maybe start on each of the issues as we proceed. Shikha, over to you.
Sir. So as you already started, we'll be classifying the entire discussion into 4 to 5 broad parts. Number one, we'll discuss about the nature of income tax liabilities and what should be the ideal treatment of those kind of liabilities, plus the anomaly which has recently arisen because of the Rainbow Papers ruling as to how to go about that. What are our 2 cents on that, and we would also want to know, what kind of situations our fellow or peers are also facing, and we would like to hear from them as well. Secondly, what are the tax implications on non-resolution, as in whether the RA would be able to carry forward and set off losses What about the taxation of remission of liability happening because of the haircuts undertaken by the creditors, whether it would be applicable on financial creditors and operational creditors as well, or either of them. Plus, what happens to certain kind of tax holidays which the corporate debtor might have been entitled to. Then we'll talk about tax implications on liquidation, as in when we sell assets either on standalone basis or say specifically in case of a going concern sale, that would be more important. When we compare a GCS with a resolution, and what would be the tax implications in both the cases, that would be quite relevant for us. Then tax implication on voluntary liquidation and distribution to shareholders. Then there would be certain procedural aspects and certain practical issues which IPs mostly face, that probably we'd also like to hear from our IPs at that point of time as well. I'll be starting with the status and the nature of income tax claims under IBC. So, as we all understand, IBC has classified the category of creditor into two parts, financial and operational, but it has not blurred the distinction between secured and unsecured creditors as well. So, a creditor can be operational and unsecured, financial and unsecured, right? There can be any permutation and combination. But when we talk about tax liabilities, it's now perfectly well settled because of all the BLRC discussions, the text of the law, as well as various judicial pronouncements so far. That tax liabilities, in fact, tax dues are operational claims. As such, the government authorities, which are imposing or who are furnishing claims on account of a statute, are operational creditors. That part is more or less settled. There is no confusion around it. But the problem has arisen with respect to the question whether tax dues are secured or unsecured. Now, before I get into this discussion, let me just think of four possible scenarios, or basically the timings at which these liabilities would have arisen. So, scenario one, the tax liability belongs to a period prior to initiation of insolvency period, prior to commencement of insolvency. Second time is during the period of CIRP. Third time is after the approval of resolution plan, say the CIRP has become successful and the RA has given a successful resolution plan. As to how would we treat those liabilities under the resolution plan, what happens to those income tax liabilities under that resolution plan. And the fourth thing is there is no successful resolution and the CD ends up in liquidation. So what happens to income tax liabilities at that stage? I'm sorry, I can hear some noises around. Request to please mute. Yeah, thank you. So these four scenarios. So when we talk about income tax liabilities as on the commencement date, as in when the CIRP has actually commenced, there have been rulings in the past. Most notable of being is Monetus Path, where the Supreme Court clearly said, in fact, the highest court of the land clearly said that Section 238 of IBC would override any other enactment, including the Income Tax Act. It relied on other previous rulings of Supreme Court in Dena Bank and said that secured dues are private debts and therefore they take precedence over crown debts. In that, keeping that in view, it was ruled, there was no confusion, and it was ruled that uh, the tax dues would become subordinated to secured dues. Plus, there were several other rulings, for example, in Leo Edibles, which is an Andhra Pradesh High Court ruling, which also said that tax dues clearly come within the purview of Section 53(1)(e), that is lower in priority than secured creditors, and not being a secured creditor must necessarily take recourse to distribution. Now, why is it saying so? We all understand in liquidation, secured creditors have two options. They can either go for, they can stand in line in liquidation and claim from the common pool of assets, or they can stand out of liquidation and enforce their own preferred asset and realize their dues from that particular asset. But since the court ruled here that the income tax dues are falling under Section 53(1)(e), therefore they don't have that privilege which is otherwise there with secured creditors. Therefore, income tax authorities should necessarily stand in line under section 53. They don't have any other option. But the table somehow got turned in this recent ruling of State Tax Officers versus Rainbow Papers Limited. This is also a Supreme Court ruling. This was in the context of GVAT Act, where we all know in case of these kind of tax acts or revenue laws, there is generally a section which would give powers to the tax authorities to enforce their dues as first charge over the properties of the assessee. So similar such provision was there in is there in GVAT Act, basis which the Supreme Court said that this particular section creates a charge in favor of the tax authorities, and therefore this tax authority would become a secured creditor under law, and therefore should be treated at par with other secured creditors. Now, this ruling actually unsettled the waters, because then what happened is the lower courts, including this NCLAT in this particular ruling, principal, this Assam, in this particular case, Principal Commissioner of Income Tax and others versus Assam Company. In this case, NCLAT held the same principle, although in the context of Income Tax Act. So the Rainbow Papers ruling was in the context of GVAT Act, but NCLAT ruling went in favor of income tax authorities. So now the question arises as in what to do in such a case where so far the idea was pretty clear. We all knew that income tax dues or whatsoever tax dues are to be treated as subordinated to secured creditors, lower in the priority as unsecured dues. And now suddenly there is a ruling which says that these dues you cannot treat below secured dues. You have to treat them at par with secured creditors. We would like to know if our fellow professional members are also receiving certain claims, although in general we see that we do not receive claims from tax authorities even after sometimes we receive claims after dissolution. But these days there's a certain spurt in these type of claims where the tax officers are claiming priorities on the basis of Rainbow Papers ruling. So before I get into the possible solution or possible arguments which as IPs we can put across, there are certain points to note vis-a-vis this particular Rainbow Papers ruling, as in what went possibly wrong here, humbly speaking. So number one, uh, first we have to look at the definition of security interest whatsoever is provided under law, because when we see the definition of secured creditor, I will take you through the provisions just to have a better understanding. Just a minute. So when we look at the definition of secured, are you able to hear, are you able to see the text of the ruling on the screen? Varsha also?
No,
No.
really.
Okay, just a minute. I'll share that text also. Is it now visible?
Yes, Shikha, it's there.
Thank you, sir. So when we look at the definition of secured creditor under IBC, it means a creditor in favor of whom security interest is created. So it does not necessarily exist, but is created. Now, when we look at the definition of security interest, it means certain kind of right, title, or interest or a claim to property created in favor of or provided for a secured creditor by a transaction or any other agreement or arrangement. Which means now when we look at the definition of transaction, it says an agreement or arrangement in writing for the transfer of assets or funds. Now, when we look at these three definitions together, secured creditor, security interest, and transaction, it becomes very clear that the idea of law is to provide for transactions or arrangements which are being entered into by mutual consent of parties, and not those which are imposed by way of statute. Plus we have also already seen that there are cases like Monet Ispat and Leo Edibles which have clearly held that tax dues are not secured dues. Now we can also refer to this MCA discussion paper which came in January. It also talks about this particular kind of anomaly arising out of rainbow paper rulings, it in fact calls for a clarification in the law, saying that irrespective of whether a charge is created by way of statute or otherwise, government dues should not be treated at par with secured creditors and should be treated as unsecured dues. So these all are possible arguments which are already existing to counter the arguments given in rainbow papers. We'll also see that in rainbow papers there was no mention of all those past rulings or even the BLRC discussions, nothing. So probably the honorable court was not aware of or was not made aware of those rulings in the past. Therefore, this kind of anomaly. So now coming to what are the possible solutions which, as IPs we have if tax authorities come to us seeking status at par with secured creditors. Now we have seen that secured creditors one in whose favor security interest is created. Now filing, one of the preconditions of taking a pie in the resolution amount or taking a pie in the liquidation waterfall is that a claimant has to file a claim. Any creditor has to file a claim. So when a secured creditor files a claim, he has to prove the existence of security interest. Now, when we look at various sections in IBC, section 38, section 39, section 52, etc., we see that, and plus read with the relevant regulations, including CIP regulations and liquidation regulations, the existence of a security interest can be proved on the basis of three possible sources. Either you go to IU, or you go to ROC's charge index, or you go to registration details with CERSAI. Now we have to now look at, see, in case of ROCs, there is no provision of filing a charge by tax authorities. IU also, so far, only financial creditors have been filing claims. Now, coming to CERSAI, there are enabling provisions in Section 26B of SARFAESI Act, which enable filing of charges, for example, attachment orders by government authorities, only to be regarded as secured creditors or to be given priorities along with other secured creditors. But so that's what we are trying to say, that in case the tax authorities want to prove themselves as secured creditors, they need to necessarily furnish the registration details
Hello.
with CERSAI. Sorry.
Hello, my question.
You can go at Shikha. This somebody's audio is.
Just a minute. I'll pause, and of course we'll invite questions and
No,
discussions.
this wasn't somebody asking questions. Somebody talking over the phone. Don't worry. Carry on.
So that's what we are coming from, that in order to prove their security interest, they might have to provide necessary evidence, and that can be a possible first step or first
Actually,
argument.
my question, I know, actually, I have a question with the sir.
Just
Hello?
a minute, sir. I'll just pause here. Just a minute, sir.
Can you allow Shikha to proceed for next few minutes, and then we can probably have some questions maybe. I hope that's okay, because Shikha is just about to finish our response to a potential claim by tax authority, and then we can probably have some discussion around it.
Correct.
Yes, Shikha, I said maybe we can go ahead.
In fact, we have also seen one Madras HC ruling in Metanaphthalon. There also Rainbow Papers Limited argument was raised, but then the court, Madras HC also commented that in case of income tax, the issue has been already settled by 178(6) of Income Tax Act, which actually excludes the applicability of Section 178 on IBC cases. So this was regarding the income tax liabilities arising prior to commencement of CIRP. In case we have any questions, and
Shikha, let's maybe start with the ruling of the Madras High Court, which refers to Section 178/6. Now, as you understand, 178 is section dealing with liquidation. So in liquidation, probably one can argue that the Income Tax Act itself has. Maybe you can, Shikha, you can keep the screen shared instead of bringing it up.
Sure.
Yeah, otherwise it shows window in window. It makes it very complicated. So let's stay on that. So 178/6 talks about liquidation, and in liquidation, the Income Tax Act itself has admitted the primacy of IBC. Because 178/6 says that this provision will override other laws excepting IBC. Therefore, the Income Tax Act has admitted that the priority of IBC is over the Income Tax Act when it comes to liquidation. However, on your point about the meaning of secured creditor and security interest, the stance of the Supreme Court in Rainbow Papers was that creation of a charge, creation of security interest does not necessarily mean contractual creation. Creation can also happen by statute. So here the statute, in view of the unpaid dues to the government, statutorily brings a charge which is automatically existing against all the assets of the entity. So effectively, the answer to Rainbow Papers is the statutory amendment itself. I'm sure that the IBBI as MC has taken note of that. And the concept paper clearly says that maybe in the forthcoming session in the parliament, hopefully the monsoon session, this problem may be taken care of by statute. But in the meantime, our work is not stopped. We are still carrying resolutions and liquidation. The question is, in the interim, if the government puts in a claim, let's say Gujarat VAT has already started sending notices. I'm guessing income tax also will be pursuing, saying that I am seeking priority with secured creditor, and therefore you need to set apart money payable to me at par with the money payable to statutory, payable to secured creditors.
Right.
At the same time, the NCLAT has taken a view that a resolution applicant also cannot disregard the dues of the income tax. And therefore, the resolution plan should also provide for proportional payment to income tax at par with the payments due to secured creditors. So looking at these rulings, the issue is how do we tackle the, sure enough, no RA, no resolution applicant is actually wanting to pay at par with secured creditors to the income tax department, or for that matter to other tax departments. But those tax dues anyway are quite often substantial. Quite often the dues are disputed for long time. They are contingent dues and they continue remaining contingent till the matter gets ultimately resolved, maybe in a trail of litigation. So in a sense, the point that you were referring to the definition of security interest, referring to registration, and you mentioned this point about section 26B, C, D, and E of the SURFACI Act was never brought before the Supreme Court. The unfortunate part is the Supreme Court, I mean, the ruling refers to only the discussion before the court, and the court was not briefed about the provisions of section 26B to E of the SURFACI Act. As you mentioned, section 26C of the SURFACI, 26C of SURFACI Act, and for the benefit of all the participants, this section says that it is possible for the government to register an attachment. If the government has made an attachment order, the government has merely the fact that there is unpaid due of the government does not mean anything at all. If the government wants to convert its claim into a security interest, the government has to do attachment. An attachment order may be registered with SURSAI. And then 26E of the SURFACI Act goes to say that notwithstanding anything contained in any law for the time being in force, after registration of security interests, the debts due to a secured creditor shall be paid in priority over all debts and all revenues, taxes, cesses, and other rates payable to central government or state government or local authority. So 26E also goes to say that once the security interest has been registered with SURSAI, SURSAI is the registry authority under SURFACI Act, then the dues of secured creditors will rank above the claims of the government. Now, we need to here see two things. Number one, are the secured creditors filing security interest with SURSAI as well? They should be filing. SURSAI does not have a time limit, unlike ROC, which is 30 days from date of creation. SURSAI does not have a time limit, so even now secured creditors can do a filing. If they have done filing under SURSAI, then 26E of the SURFACI Act will come to the rescue, and they can claim priority over the central government or state government claims in view of 26E of the SURFACI Act. I think that's where probably some solution may lie, asking the secured creditors to do SURFACI registration. And sure enough, the government wouldn't have done that, and therefore the government claims may not be. In fact, 26E talks about attachment. The government wouldn't have done attachment. I think what we need to understand, there's a difference between having a charge and having attachment. Attachment fastens the security fastens the security interest to specific asset. Otherwise, having a kind of overhanging charge on all the assets, in any case, will make the claim subordinated, because as per law, if a charge exists on specific assets versus a charge existing on general assets, any asset, The latter part is called a floating charge, and a floating charge is by definition subordinated to fixed charges. This has also been held by Supreme Court in case of ICSA versus Hidco Leathers. Subsequently, the same principle has been used under IBC cases as well. So to my mind, two things. Number one, the government claim is still subordinated, being a charge on general assets, not a charge on specific assets. And number two, it's not converted into attachment. In any case, the attachment is not registered under Section 26E, and therefore 26E will provide priority to other secured creditors. I think that might probably be the way to deal with it. Shikha, if in case you want to add something, or otherwise participants might want to have some discussion on this.
Just this point, sir. This 26E can be of help where the secured creditor is actually enforcing the security outside IBC. But when the secured creditor is inside the liquidation or inside IBC, then probably there can be a gray area still. But yes, we can always rely on this 26B and C, where the government and other creditors do have the right to register the attachment orders as well. So that at least that requirement can be sought for.
Shikha, if reading from 26C, it says notwithstanding blah, 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 debts due to a secured creditor shall be paid in priority over all the debts. So
Sir,
I think it's talking about general priority, but let's discuss with other participants as well if there are any further thoughts coming in.
sir,
I think Ms.
sir,
Anil
may I have a
Patwal.
question?
Yes, sir. Yes, sir. Go ahead, sir.
Yes, actually, sir, that there is, rainbow paper mill case for the this sales tax officer take the to the Supreme Court this case. It is Gujarat VAT. We want to have the priority. Hello.
Sir, go ahead. We are
Yes,
listening. Sir. Go ahead.
sir. You're audible, sir. You're audible, sir.
Yes.
Please.
So the Gujarat, I think there is we are mixing two things, income tax and Gujarat VAT, because where is the interpretation rule of law. So Supreme Court, I think, use the interpretation of harmonization of the statute, because if there is, in IBC, there is so many act, they put some changes, income tax, excise, and a lot of act, I think the 11, 13 in schedule, but they didn't change anything in, VAT. And VAT is specifically mentioned that they have the priority and they can recover the money from the cargo debtor. So in this case, I think that the Supreme Court used the principle of interpretation of harmonization between the law. That's why they took that decision in case of income tax or any other dues, which will be we should consider if it is a unsecured creditor and should deal with according to that. If there is any problem, so we can go to the NCLT for the clarification or way forward. That is my
पटवाल साहब, थैंक यू वेरी
submission.
मच. थैंक यू वेरी पटवाल साहब. आपने जैसा कहा कि आईबीसी जब बना 2016 में, IBC had a schedule where IBC made corresponding changes in a lot of other laws. लेकिन IBC couldn't have thought of making change in laws of all the states as well. कितनी सारी state governments के कितने सारे laws हैं. It was not possible for IBC to make changes in all other laws. लेकिन एक settled principle है, Central Bank of India versus State of Kerala, that in case of any conflict with a central law and a state law, the central law shall prevail. IBC is central law. And IBC being a central law, IBC itself has a priority over all other state laws. But anyway, Rainbow Papers ruling, Supreme Court is supreme. Supreme जो court है, with due respect, now that's the law of the land, and therefore we have to wait whether statute brings a resolution to this problem. लेकिन हमको statute में change जब आएगा तब आएगा. हमारा काम तो रुक नहीं रहा, हमको इस बीच में काम अपना करना है. तो अगर आपके पास गवर्नमेंट क्लेम्स आते हैं फॉर ट्रीटिंग द गवर्नमेंट एज पार्ट विद सिक्योर्ड क्रेडिटर्स, उसको इस बीच में कैसे हम लोग हैंडल करें, दैट वाज आवर मेन डिस्कशन हियर. तो माय माइंड वी कैन रेफर टू 26B, C, D, E ऑफ सरफेसी एक्ट. वी कैन रेफर टू मीनिंग ऑफ सिक्योर्ड क्रेडिटर्स. आज द गवर्नमेंट की आप रजिस्ट्रेशन दिखाइए कहाँ किया आपने. तो इस तरह हम लोग थोड़ा सा इसको, माने ये क्या इंटेलेक्चुअल बैटल है, इसमें अल्टीमेटली स्टैट्यूट जब आएगा तब चेंज होगा. लेकिन आज तक जब तक ये नहीं होता तब तक हमें कैसे अपना जीवन चलाना है, that's the basic issue. Any other
Sir, my question.
I have a question.
Sir, I have a pertinent question relating to same context. that during CIRP, there are only two terminology has been used. One is the FC, another is the OC. There is no secured, there is no unsecured creditor. In that case, RP or IRP, how IRP or RP should treat that claim in case of state tax of Gujarat? They are asking to treat them as a secured creditor. NCLT has also passed the order to treat their claim as a rainbow judgment. They are not passing judgment for the secured unsecured. So rainbow
Ahmedabad
judgment
Tribunal, I think, has passed as a ruling. Ajay ji, you're right. And Ahmedabad Tribunal has passed a ruling to treat Gujarat government as a part of secured creditor. आपका कहना सही है अजय जी, there are only two terms: secured creditor, unsecured creditor. Sorry, FC and OC. Absolutely right. But even an OC can be secured. Now, resolution plan has to pay liquidation value to each creditor. Liquidation value means what? Liquidation value comes from section 53. So the moment you apply section 53, once again, we are talking about secured versus unsecured. Matlab, even if there is a secured operational creditor, if there's a secured operational creditor, no secured operational creditor can be paid a value less than the value of the underlying security interest. So if there's a secured operational creditor having a charge on specific asset, the value that can be offered to such creditor has to be at least the liquidation value, which is why we relate it to section 53, which is once again based on secured versus unsecured. And hence,
how should RP or IRP write in the claim chart?
Claim में तो OC है. There's no doubt. Government claim is an operational creditor for sure.
OC secured.
अब secured unsecured का, that's exactly what the discussion is. कि security interest कहाँ है? आप बोल रहे हैं secured, तो security interest बताइए. कहाँ register करा है आपने? बताइए. Because I have, as a resolution professional, I have to go by my law. My law is IBC. IBC says there are three evidences.
Sorry.
Yeah. I'm saying there are three possible evidences. या तो IU में दिखाइए, information neutrality, या ROC में दिखाइए, या फिर सरसाई में दिखाइए. तीनों नहीं है तो मेरी process तो does not admit any.
Law itself says, rainbow judgment says that law, the statute of Gujarat itself provide that in case of default in payment of state tax, then creditor, the state tax department will have automatic charge on the assets of the company. That is by operation of law, not by the registration and other thing.
Ajay ji, similar provision exists in laws of just about every state. ऐसा इंडिया में कोई स्टेट नहीं जिसमें सिमिलर प्रोविजन नहीं हो. सब स्टेट में ऐसा प्रोविजन है. सबसे पहले महाराष्ट्र लेके आया था बॉम्बे सेल्स टैक्स एक्ट. I think 1975 sometime Bombay sales tax was wrote this provision. It was then imitated by all the state governments. So आज के दिन सब state government में ऐसा ही law है. The Gujarat VAT is not an exception. Gujarat is, well, of being the most proactive state in the country, they've taken the lead in taking the matter to Supreme Court, but the provision is there in every law. But आपका एक बोलना ठीक है कि it's automatic statutory charge, but as an IP, I am entitled to take a charge or to claim a secured claim based on some evidence. So मेरे पास क्या evidence है? I have to rely on evidence. आप बोल रहे हैं आपका charge है, तो just because there was a demand existing, I cannot take it as a charge. Because as per the process provided by CRP regulations, I have to ask for evidence of security interest. मेरे पास है नहीं evidence. In fact, they could have done सरसाई registration. किसने रोका? सरसाई registration कराइए आप. सरसाई में प्रोसेस है आपका रजिस्ट्रेशन करने का. आप कर लीजिए.
If parliament or state legislature itself provides, then there is no question of separate evidence. In my view, because of this, the Supreme Court has taken the same view because the state law itself provide.
आपका कहना ठीक है, लेकिन सवाल ये है कि अगर हमको secured मानेंगे तो that would mean the resolution applicant will have to set aside a proportional claim to government dues also. Government dues कब कितना उठ जाए क्या ठीक है. आज के दिन 2 करोड़ की लायबिलिटी है. 2 साल के बाद देखें वही लायबिलिटी 200 करोड़ होगी. तो आप कैसे गवर्नमेंट ड्यूज को क्लेम करें, कैसे गवर्नमेंट ड्यूज को ट्रीट करें? अशोक कुमार जी.
Yes, Kothari sir, yeah. Say, I think your point of view appears to be more practical. Say there is a waterfall mechanism defined in section 53, one thing. Then there are certain, overriding decisions by Supreme Court in particular. But ultimately, there is a word, creation of security interest. And there are ways and means to create a security interest. Only thing is that if it is not done by, say, income tax department or any other department, if they have not registered their claims with the SARSAI or any other such agency which is required. I think as a IP, I can very well take a stand that say the case conditions are different when the case goes to a particular court, maybe Supreme Court or some other competent court. I need to go on the basis of the case details with me. If there is no security interest created by any government department, I will treat that as a waterfall mechanism, that is section 53 1E. I think that should be the correct stand, because you know what happens. The statute is one thing. Then there are different courts or NCLATs giving different views based on circumstances of a particular case. But I need to go as per the overall gamut of whatever is available with me, and finally whether really security interest is created or not. Then only it would. Otherwise, there is another debate of whether first charge order or second charge order. Still, it remains, I think, unresolved. When
Thank you,
secure
Ashok.
creditor, then what is the meaning of first charge and second charge? Always the banking industry, we have been doing it first charge or pari passu charge or second charge. So there also the question of proportionate distribution of the value will come.
Thank you, Ashok ji. Thanks very much.
Vinod sir, my limited point is that we can argue to the extent we can, but unless until the statute is not amended, nothing will happen.
Correct.
So I
Completely
think the
agree
only
with that.
solution is amendment to the statute.
But that will still be some months away, sir, because it will be, we need to wait for some
No,
months.
sir, my understanding is no plans are getting approved in the interim. All the plans are pending at the NCLT because of this rainbow judgment.
I mean, approval of plans is one part. You might also be acting as liquidator. In the meantime, you might be getting a demand or claim from the government. The issue is, how do we tackle it in the meantime? So you're right that ultimate remedy comes from a statute taking care of its basic intent. But in the meantime, life doesn't stop for us. We have to continue moving the process. So if you are getting stuck, then how to address in the meantime while the law is still awaited. That was our submission. But eventual remedy, very rightly, will have to come from the statute. Shikha, want to add something, or you want to move to the next one? Maybe?
No, so let's move to tax implications during CIRP. So these are certain key issues in CIRP which we'll be discussing with your due participation. So number one, whether the benefit of carry forward and set off of accumulated losses will be available to the resolution applicant or the new CD. What kind of treatment would occur to those haircuts taken by creditors, whether that would be treated as an income in the books of the new CD, what would be the MAT implications, what happens to the past tax claims, as in what is the impact of past tax claims on the resolution applicant. Now we also see that in most of the resolution plans, we have merger or demerger or amalgamations happening. So what would be the tax benefits in such cases? So coming first to carry forward and set off of losses under section 79, it provides for ability to carry forward and set off of losses in case there is a change in control. So this particular section 79 deals specifically with a company in which the public are not substantially interested. So in such cases, it says that in case of a change in control, no carry forward and set off of losses would be available. Now, there were amendments in subsection 2 of this section, specifically providing for IBC. It says that nothing contained in subsection 1 shall apply to a company where a change in shareholding happens in a previous year pursuant to a resolution plan approved under IBC after affording a reasonable opportunity of being heard to the principal commissioner or commissioner. Now there is a clause D also, which was inserted, which deals with to a company and its subsidiary and the subsidiary of such subsidiary, basically the company and subsidiary and the step down subsidiary, where the change in shareholding happens pursuant to a resolution plan under IBC. Vinod sir, will you take it forward from here?
Thanks, Shikha. So as Shikha mentioned here, the basic issue is the eligibility of the resolution applicant to claim the benefit of carry forward and set off. Very obviously, we're talking about a company with huge pile of carried forward losses. The company goes for resolution. And obviously, there is a change of control because resolution itself means the RA comes in, the existing promoters go away, the new shareholders come. That's a change of control. And quite often, the companies which are undergoing resolution are closely held companies. They are companies in which public are not substantially interested in terms of definition of Section 2/18. They are so-called closely held companies. So here the provision of the law intended very clearly amendment made in 2018 to say that the benefit of carry forward will not be denied in case of change of control happening pursuant to resolution plan, provided an opportunity of being heard was afforded to the principal commissioner or commissioner of income tax. Now, one is not clear on what exactly is this opportunity of hearing, who has to provide the opportunity of hearing. Are we therefore saying that during the NCLT hearings, the commissioner of income tax is also one of the parties? Well, I think as long as the matter is open for a commissioner of income tax also to appear as an interested party, and the NCLT would obviously be open to hear the contentions of the commissioner of income tax as well, the question of affording reasonable opportunity to tax officer has already been taken care of. But when it comes to the tax losses in subsidiaries, that is where the language of law is not at all clear. Because there, if you look at the provisions of Section 79/2 clause D, now there the language becomes quite murky because it says to a company and its subsidiary and subsidiary of such subsidiary where, and I'm reading Roman 2, which says a change in shareholding of such company or its subsidiary and the subsidiary of such subsidiary has taken place in the previous year pursuant to a resolution plan approved by the tribunal under Section 242 of the Companies Act. It suddenly makes a reference to Section 242 of the Companies Act. Section 242 of Companies Act, I'm sure you are all aware, is a section dealing with oppression and mismanagement. Section 239 to 40, etc. are matters dealing with oppression. In a case dealing with oppression, the tribunal has power, NCLT, not adjudicating authority in that case. The NCLT has power to provide for change of management also. So therefore, are we saying that as far as the benefit of carry forward or losses to a subsidiary is concerned, that will be available to a resolution applicant only if the change happened in pursuance of Section 242 and not IBC, then the whole purpose of this amendment gets frustrated because it refers to, it starts with IBC first. So change in shareholding of company which has taken place in previous year pursuant to resolution plan approved by tribunal. Very clearly is referring to resolution plan and then makes a reference to Section 242. So it seems very clearly that the reference to Section 242 of the Companies Act is probably erroneous because resolution plan is not approved in terms of Section 242. Resolution plan is approved under IBC. So as far as the ability of subsidiaries of the corporate debtor is concerned to claim benefit of set-off, that seems to be in doubt. But as regards the corporate debtor itself, there seems to be no doubt as to the eligibility of the corporate debtor to claim benefit of set-off and carry forward. That is because there's a continuity. The corporate debtor continues as an entity. The obvious question is that the CD must be continued. If the resolution applicant decides to merge the CD into some other entity or decides to demerge an undertaking out or to merge some other entity into the corporate debtor, then we are talking about the eligibility of carry forward and set off in case of amalgamation, demerger, etc. But if the CD is continued as such, then the right to claim benefit of carry forward and set off seems to be coming very clearly by virtue of the explicit provisions of the law. Now, if the resolution applicant decides to move the matter or move the CD, say by way of a scheme of merger, demerger, or say by merging some other entity into the corporate debtor, then the situation will be dependent on whether such scheme of arrangement meets the definition of amalgamation as per Income Tax Act or meets the definition of demerger as per Income Tax Act, and whether the conditions of carry forward or set off of losses under a scheme of amalgamation or demerger are getting satisfied. So there are three possible scenarios. The corporate debtor continues as is, that is without change of corporate personality. In that case, section 79/2 automatically comes in, and therefore the right of claiming set off or carry forward is not disturbed. If the CD is merged into some other entity, then we need to see whether conditions of section 72A pertaining to schemes of arrangement are being satisfied, read with the definition of amalgamation once again as per the definition of amalgamation as per Income Tax Act. Very often you will find the corporate debtor is demerged, or some of the undertakings are demerged into separate companies. There will once again need to see whether the definition of demerger and the conditions of section 72A/4 are being satisfied for transferring the tax benefits to the demerged entity, the transferring entity in case of demerge. A third scenario can be some other entity is merged into the corporate debtor. Quite often the scheme might be that here is a company having brought forward losses. We merge some other profit-making entity into the corporate debtor. In that case, there is no challenge because we already saw that change of control which is happening pursuant to resolution plan is already covered in the section 79. Now, if because of a merger of some other entity into the corporate debtor, if there is a further change of control that's happening, then the carve out or the protection under section 79/2 that we just noticed, that will not be available. Therefore, I'll need to repeat myself that if there is subsequent to the resolution plan, that is not coming out of resolution plan, but separately that is independent of the resolution plan, we decide to do a merger of some other profit-making entity into the corporate debtor. And as a result of that, shares of the CD are issued to shareholders of those merging entities. There may be a situation of change of control, that is more than 50% shareholding might change. And if that situation happens, then the ability of the entity post the change of control to be able to claim the benefit of set-off will still be questionable, because we will not have the benefit of the explicit carve-out in section 79/2, which is available only in case of change of control happening pursuant to resolution plan. So that allows us to summarize situation. As long as there is no change of, or as long as change of control is a part of resolution plan, we will not have an interruption in the ability to claim benefit of set-off and carry forward. If we do a scheme of arrangement, which may or may not be a part of resolution plan, if scheme of arrangement may or may not be part of CRP, may or may not be a part of resolution plan, because even if the scheme of arrangement is not a part of resolution plan, there are still explicit provisions in Income Tax Act dealing with schemes of arrangement. So those provisions will still be applicable. And if there is some other merger that happens into the corporate debtor, not as a part of resolution plan, then if there is change of control because of such merger, then there might be a challenge to the ability to claim tax benefits. So if I can scroll down to the conditions of amalgamation, as we are well aware, the provisions of Income Tax Act define a scheme of arrangement in terms of section 2(1)(b) of the Act, and there are conditions given in section 2(1)(b). Number one, all the property of the transferor gets transferred to transferee. All the liabilities also get transferred, and shareholders to the extent of at least 3/4 in value of the transferor become shareholder of the transferee as a result of the scheme of arrangement. Right? And
can I have one question, please?
so I just want to finish for 1 minute and then we can
Oh.
just give me 1 minute. This is as far as the definition of amalgamation is concerned. Now, for section 72A comes in, for which lays down this conditions, subject to which a transferee in a scheme of arrangement will be entitled to claim benefit of set-off in the transferee entity. And the conditions laid in section 72A, there are some conditions laid in the section itself. and there are conditions which are coming from the rules. The primary conditions laid in the section and the rules are basically that the company in question satisfies the definition of an industrial entity. It must be an industrial undertaking. And then it goes to say at least 3/4 in value of the assets must continue post the amalgamation as well. And then there are other conditions about continuation of business and that the amalgamation was for the purpose of revival or restructuring of the entity, which of course is the case in a resolution plan. So as long as we are meeting the conditions of amalgamation, that is, if the corporate debtor gets amalgamated with some other entity, then there's a question of shifting of tax benefits to transferring entity. There, the conditions of section 72A/2, read with the relevant rules, have to be adhered to. But it would be, I would say, relatively easier to think of a scheme of demerge, because the conditionalities to be satisfied in a scheme of demerger are relatively easier. Shikha, if you can move to scheme of demerger.
Yes.
In a scheme of demerger, which is defined in section 2/19AA, conditions being the property should be transferred. First of all, it must be an undertaking. Remember always that demerger is applicable only when there is more than one undertaking. That is, we need to satisfy that the CD was consisting of more than one undertaking and we are shifting one undertaking from the company. Mere transfer of assets can never qualify as transfer of undertaking. If what we are doing is simply transfer of assets and not transfer of undertaking, then the tax neutrality in case of demerger will not be applicable. So it must be transfer of undertaking. And the word undertaking once again is defined in the section. So it must be transfer of undertaking where all property of the undertaking is transferred to resulting company. All liabilities are also transferred. The transfer of assets and liabilities happens at book value. The transferee issues shares and shareholders to the extent of at least 3/4 in value of in the demerged entity become shareholders of the resulting company. And the transfer of undertaking is carried out as a going concern. If these conditions of section 219AA are satisfied, then the relevant provision for shifting the carry forward losses pertaining to the undertaking, that is, the moment you talk about demerger, we are talking about losses pertaining to the undertaking, not losses pertaining to the assessee. Assessee is the entity. We will need to identify the losses which pertain to the undertaking, and those losses can be shifted to the transferee entity in terms of section 72A/4. The conditionalities in 72A/4 are much easier than the conditionalities under 72A/2, because the undertaking need not be industrial undertaking. 72A/2 requires the undertaking to be industrial. 72A/4 does not require the existence of an industrial undertaking. Therefore, the conditions are relatively easier if you want to do a shifting of losses to another entity. I'm sure you understand that in case of resolution plan, that's one of the basic. The basic idea is not to waste the benefit of deferred tax asset. We're talking about a insolvent undertaking. There might be substantial extent of deferred tax asset, and that's quite a value. So in order not to lose that value, we'll have to think of shifting of the losses to an appropriate place where the losses can be appropriately adjusted. Therefore, the question of either amalgamation or demerger is quite often thought of. Quite often that's a part of resolution plan itself. But even if amalgamation or demerger are part of resolution plan, still, as there is no explicit, carve out from section 72A to a resolution plan, the shifting of losses will still have to meet with the conditions of section 21B or section 219AA as the case may be, and 72A/2 or 72A/4. So that is the condition for availing the benefit of set off and carry forward in CRP matter. Let's maybe have a short discussion around this before we move to slum. Manish, you were saying something.
Yeah, I have one question. Whether this condition is applicable, we can do the rearrangement while the company is in liquidation. So whether these conditions apply to the only resolution plan, or we can have the benefit during liquidation also.
We are coming to liquidation separate. So next few minutes we'll talk about liquidation too. So let's maybe hold it in the meantime. Anything else about CRP when we talk about as far as slum sale is concerned, slum sale is essentially a easy process for computing capital gains. Unlike amalgamation or demerger, which are supposed to be tax neutral, a slum sale does not have tax neutrality. Slum sale is as much chargeable to capital gains as any other transfer of capital assets. The only advantage of slum sale is that instead of computing capital gain with reference to individual assets, we compute capital gain or capital loss with reference to a undertaking. That is, we do not do asset by asset allocation of the consideration to specific assets. We compute the entire capital gain on transfer of undertaking itself. That's only a matter of convenience, and particularly it may be useful only where on some of the assets there might be capital gain, on some of the assets there might be capital loss. So instead of mutual set off of capital gains or capital losses, it might be desirable to use the slum sale process to have an easy process for transferring the undertaking itself. In a sense, slum sale is not a tax neutrality provision. In CRP also, slum sales quite often may be done as a part of resolution plan, or maybe during CRP also. It might be desirable to shift or transfer undertaking out. Sometimes the committee of creditors also might desire an undertaking to be completely shifted. So the issue basically is that if you are doing any transfer of assets and transfer of capital assets during CRP as a part of CRP process itself, there also capital gains or capital loss implications will still arise. If you're doing a transfer of assets resulting into a capital gain, there is a capital gain tax implication. So merely the fact that you are undergoing resolution does not absolve the obligation of complying with tax provisions. If there's a tax implication because of a transfer of capital asset, the implication would still be applicable to an entity under CRP as well. Before we go to the next stage, which is liquidation, there are several issues during liquidation. Navinji has raised his. Navinji, please say your question. Mr. Navin, sir.
Vinodji, I would like to make a comment. In case of slum sale, am I audible?
You are, sir. Good.
Okay, so in case of slum sale, if I remember correctly, it could be long-term capital gain if the entity or if the division is there for more than a specified period.
3 years.
Whereas in case of asset sale, in business asset sales, except for land, it would be short-term capital gain.
Yeah,
right?
Depreciable assets, correct. In case of depreciable assets, we apply section 52, under which the depreciable assets are always taken based on block basis. So based on the sale proceeds versus the block of the assets, the resulting gain or loss, mostly resulting gain or loss may not arise unless the entire block is getting sold. But if at all there's a gain, the gain will be taken as short-term capital gain. You're right. Navinji, you're right. If you choose slum sale, then you are not required to compute the block basis sale proceeds versus WDV. You can treat the entire undertaking as single asset, and you can take the net worth of the undertaking and the sale consideration. The difference between the two is taken as long-term capital gain or long-term capital loss, depending on for how many years the undertaking has existed. You're right. So the provisions of slum sale have now also been extended to slum exchange. And Shikha, I think with this we can probably move to liquidation, which I think is having several. Just to quickly mention about continuation of assessment on successor. This is a specific provision which was inserted in section 170, and last Finance Bill 2023 also has made some changes in section 170A. Now, this basically is a procedural provision which says that sometimes while the assessment proceedings are going on, there might be a change of an entity by virtue of a order of court. The order of court may be under an amalgamation or a merger or demerger, or the order may also be pursuant to resolution plan. That is, if at all there is a change of entity happening during the continuation of assessment proceedings, then the assessment proceeding on the predecessor, that is the entity which was existing before this court order, will be deemed to be a proceeding against the transferee. This is actually to avoid a difficulty, because earlier there were rulings to say that if the entity itself against which proceeding was existing has ceased to exist because of, let's say because of a merger, the entity has been dissolved. So there were rulings to say that because the entity itself is not there, there's no question of any proceeding against an entity which is now ceased to exist. So section 170 was amended by inserting subsection 2A to say that in case of a succession, and succession here includes IBC also, the proceedings against the predecessor will be deemed to be proceeding against the successor entity. That is transferor, the erstwhile entity, the proceedings against the erstwhile entity will be deemed to be proceedings against the resulting entity. So this is basically a clarificatory provision. And like I said, in 2023 Finance Act also, this the concept of successor and predecessor has been extended to IBC proceedings as well by adding an explanation below section 172A. This was section 170, but I think we'll have a more relevant discussion when it comes to 156 is separately we'll need to discuss it, a very important provision. But let's talk about liquidation first, then we come to 156A. Shikha will also need to talk about we just mentioned those slides and we need to come back on that. Number one, the question of taxability of the haircuts. That is, what happens to the haircuts? Do they become taxable? That's one part. Number two, the provisions of MAT on the right back of liabilities. And thirdly, the provisions of section 156(2)A, that also 156A that we need to discuss as well. In the meantime, let's first discuss liquidation. Then we come back and talk about the incidence of tax on account of right back of liabilities. Maybe I think let's discuss liquidation briefly and then we come back on these provisions. Shikha, over to you.
Sure, sir. So when we talk about tax implications and liquidations, so first of all, we all understand in liquidation involves sale of assets that might happen by way of standalone sale of a particular asset, or say a block or parcel of assets, or by way of even a slump sale or a going concern sale. So most of the concerns would arise in case of a going concern sales. Now, first question is generally, first of all, we need to understand the difference of a typical going concern sale, which would happen in a normal scenario, versus a going concern sale, which would happen in liquidation. So the first important difference is that in case of a GCS in liquidation, we are not talking about carrying over the liabilities, right? Unless and until the COC or the SCC specifically decide. Now, when we talk about, say, capital gains, sir recently remarked that, when we talk about sale of assets, say in case of resolution or say liquidation, if there is a capital gain implication, can the IP avoid payment of those taxes? So we would see that there are certain rulings at the level of NCLT where they have said that such kind of tax implications which arise due to sale of assets during, say, CIRP or say during liquidation, those should be treated as good as income tax liabilities prior to insolvency commencement. That is, they should be paid as per section 53. However, in our view, that would lead to breach of tax provisions, because we understand in past also there has been a debate around whether liquidator needs to comply with payment of taxes or related provisions during the entire process. So correct me if I'm wrong, there is a ruling in the case of Hindustan Urban Infrastructure Limited where the SC has held that liquidator is in fact a dealer in terms of a sales tax law, and therefore he needs to pay those taxes which arise during that process of when during that process of liquidation itself, and not the past liabilities, of course. So going back by that principle or proposition, we are still saying we are of the view that the taxes which arise during the liquidation period should be treated as liquidation cost, although we'll find that there are certain contrary rulings to that effect. Similarly, when we talk about, say, TDS, say suppose the liquidator has sold some immovable asset, and therefore there would be an implication under section 194 IA. So in that case, whether the liquidator should deduct TDS. So Again, there is a contrary ruling in Om Prakash Agarwal by NCLAT, where it was said that such deduction of TDS is not warranted because it would fall under Section 53 and would be contrary to IBC. But again, we have a different view here, going by the same rationale. Sir, you would want to add here something?
I think, thanks, Shikha. Let's summarize the tax issues arising in the liquidation and then compare this with the tax issues arising out of CRP. CRP, the stance is resolution. Quite often the corporate debtor remains intact. Mr. Kanakabari will just be coming back to it, sir. The stance in CRP is resolution. We're trying to resurrect, repair, restore the entity and bring it back on its feet. That's the whole stance in resolution. In liquidation, the stance is sale of assets. The assets get sold. Assets may be sold, as Shikha mentioned, in several ways. Assets may be sold on piecemeal basis. Assets may be sold on slum sale basis. Assets may be sold by way of a going concern sale. Going concern sale becomes a separate issue by itself. And that is where, I mean, the intermixture or bringing the CRP principles during liquidation comes in. Quite often there are several, in fact, NCLT rulings now, which seem to be equating a GCS sale during liquidation to a CRP resolution. And that brings very interesting points to which we'll revert to briefly. But let's first talk about the tax implication during liquidation. Liquidator is obviously going to sell assets. Liquidator realizes assets by selling them. And as you sell assets, questions of compliance with various provisions of law would come. Let's say you're selling assets and the sale of assets attracts GST. Are we liable to pay GST? Very surely, yes. I think it becomes completely a no-brainer to say that whatever taxes, whatever legal compliances, whatever compliances with applicable laws have to be done by the company as if the company was in existence. So what happens? When the company is in liquidation, the company is being administered by the liquidator. The company is still existing. The company is still continuing. Until the company is dissolved, the company is still in continuation. There's no doubt on that. This has been, I mean, consistently the ruling of courts that until dissolved, the entity continues. Marshall's and Supreme Court ruling has been, I mean, in operation for several years now, that the company exists before it's dissolved. So all compliances as are required by the company, which normally are the responsibility of board of directors, become the obligations of liquidator during liquidation. If it's selling assets and the sale of assets brings in some tax consequences, say GST, say for that matter stamp duty, would it be open for the liquidator to say that I will not pay GST, I will not pay stamp duty because I am a liquidator? So to my mind, these are the incidents of the sale transaction itself. Like expenses on sale are a necessary part of the sale transaction. Similarly, GST on the sale, and I would hasten to add that even the capital gain implication, if at all there's a capital gain implication arising out of sale, the capital gain also becomes a part of the sale process. To say that the capital gain arising because of sale will have to be met under Section 53, to my mind sounds bit strange. I'm aware Shikha mentioned that there are rulings to say that tax liability will be paid in terms of Section 53, which means while we sell assets, we incur a tax liability, however, will not pay it because in terms of waterfall, there is not enough money to pay the taxes. That seems very counterintuitive. However, one must say that while you are in CRP or in liquidation, we must ensure that we are continuously filing returns of income. We're filing tax returns. Because if you're not filing tax returns, then your ability to claim the benefit of set-off of losses will be subject to question. So you should continuously be filing returns of income, even though the company is in losses. But the ability to carry forward the benefit of losses also is subject to filing returns of income. So continuously keep filing returns of income, such that if there is a potential question of tax, as we were just discussing, in case of depreciable asset other than land, in most cases, the tax incidence on account of sale will result into a short-term capital gain. And if you have a short-term capital gain, you have a business loss also. So you can set off the losses, you can set off past carry forward losses against your potential tax capital gain implication. so as to not result into a tax payment. So that's one important principle, that while we are in CRP or liquidation, we must be Shikha, you can stay on the slides. We should continuously be filing our returns of income so as not to lose the benefit of set off or carry forward of loss. That's one part. Second part, if as a part of liquidation we do a slum sale, now there again there might be a question of tax, because you're then computing the net worth of the undertaking and comparing that with the sale consideration. Usually, though I'm not ruling out the possibilities of capital gain being there, usually the sale realization, at least on some of the assets, in fact, most of the assets will be lower than the carrying forward, the carrying value or the WDVs of assets. And therefore, the question of any capital gain may not be there, but there might be some assets. For example, if you're holding shares, you're holding some asset which is appreciated much in value, there might be a question of significant capital gain on some of the assets. So if you have capital gains on some assets, you have capital losses on the others. During the year, long-term capital gain, long-term capital loss may be mutually set off. So carry on the benefit, avail the benefit of set off if you have capital gains in one and capital losses in the other. Normal rules of mutual adjustment of set off will be applicable here as well. There's no specific carve out in case of liquidation. Therefore, if the net result of any sale of assets is a payment of capital gain liability, to my mind, this is a part of the sale process itself. To say that it's not defined as liquidation cost, or to say that it has to be settled in terms of Section 53, to my understanding, is not a correct position of law. Similarly, if there's a question of deduction of tax at source, many payments that we make are liable to tax reduction at source. For instance, let's say you make payment to retainers, you make payment to advocates. We have deduction of tax at source on each of these. So deduction of tax at source under 194 IA also, if at all applicable, will have to be done. So therefore, the liquidator has to comply with all the provisions of law as were applicable on the company if the company was a going concern. We will be talking about GCS, that is going concern sale and liquidation separately, but as of now, this is our quick position on the tax implication during liquidation. Mr. Kankabharai probably has something to say. Mr. Kankabharai. Mr. Kankabo, you can speak up your question. If not, then maybe we can move on to going concern sale.
Sir, may I ask a question?
Yes, sir, please.
Sir, suppose in 2022-23, a liquidation process starts, and liquidation process is going to complete in the year 2022-23 only. So in that case, how the liquidator will file the income tax return? Because income tax return he can file only in the next year. So in that case, what will he do?
To my recollection, there is a provision of income. This is not just limited to, this arises very often in voluntary liquidations also, because voluntary liquidation is very fast completed and you have to file return. There's a specific, to my recollection, there's a provision. I don't know whether Shikha, you'll be able to recall. There's a section which says that during the year itself, in case of companies under liquidation, you can file return of income.
No, sir, that's the problem. In income tax return cannot be filed with 2022-23 financial year return. You cannot file in the 2022-23. You have to wait for 23-24. Sir, in a company, I am acting as a voluntary liquidator now, and the liquidation process has already been completed, but I could not file income tax return in 2022-23. So I had to wait till the completion of the financial year.
Mr. Jana, I must first say that you are lucky that you would complete liquidation in 1 year.
Yes, sir, it's a voluntary liquidation. Sir, it's a voluntary liquidation.
Even voluntary.
Our irony that we are facing, and I think others are also probably facing similar irony, is that even if it's voluntary, the matter remains in NCLTs for years altogether. You might do your job in 3 months, but the NCLT will take 3 years to decide. So, Mr. Jana, you are lucky that you could complete in 1 year, I must say. First.
No. Sir, my problem is that I am unable to file the income tax return.
I'm coming to that. My recollection.
Sir, I would like to say here that because income tax portal doesn't show the assessment year for 23-24.
I know,
Yes.
practically
Yes,
that's the problem of the portal, but I recollect, I'm not sure if Shikha would be able to find it. There are other colleagues also of mine probably might have joined. But there is a provision which, I mean, I'm recollecting that because this is something which was there earlier as well. Liquidations under IBC apart, there were earlier liquidations under Companies Act as well, for which there was a specific provision saying that based on estimate basis, the liquidator may file the return of the year in which the liquidation gets completed, not wait for the assessment year. We always go by a trailing concept.
But forms are not available. Forms for 2022-23 are available only after completion of the year.
It would be filed as tax return for assessment year 22-23, during assessment year 22-23 itself, in which income for assessment year 23-24 may also be added, and that return may be filed accordingly. To my recollection, there's a problem. I'll try to see if.
So we'll check this. We'll check this.
We'll check it. But I recollect that there is a provision.
Sir, in case estimation becomes wrong, suppose estimation says we calculated income as it says 10 lakhs and later on it discover as like 15 lakhs, then what will happen?
We would have completed the process. Now, how can the income change? Because we have done voluntary distribution, we would have distributed that thing also. Possibility of income changing thereafter, to my mind, is mostly not there. It's just a procedural issue that we will file in FY 22-23 as if it was return filed for assessment year 22-23, but includes the income of the running year as well. I mean, I'm saying, I'm distinctly recalling that there's a provision, but I'll try to trace that provision of law. But let's maybe.
Sir, just 30 seconds. Sir, just 30 seconds. I just want to put one thing, sir. Sir, suppose in the 2022-23, I remain unable to file income tax return due to because the portal does not allow me. In that case, in my opinion, the liquidator is not liable to file income tax return because IBC 238, what I understand, 238 overrides the income tax return in this case. Income tax act in this case. Therefore, in my opinion, liquidator is not required to file income tax return.
I don't know. Practically, when you take the matter to NCLT and file for dissolution, the NCLT will ask you, have you filed returns of income? Have you paid off all your liabilities? So
because Om Prakash Agrawal case clearly says that section 238 overrides.
I completely get your point, Mr. Jaina, but when you take for dissolution, I think the NCLT will quite often ask you. They'll specifically ask you to notify the tax department once again, even though you might have given notice.
Income tax department has already been notified because when we start income liquidation, we have sent a letter to them, but they don't respond generally.
Correct. Now, but earlier the NCLTs were asking for a no objection certificate also, but now because of IBBI having interfered, and IBBI says that there is no need to obtain NOC of the tax department, the NCLTs are not asking for NOC, but the NCLT will ask you to affirm that you have complied with all your obligations under Income Tax Act. That's my thinking. Others might probably have a different view, but when you go to NCLT, they'll ask you to do a confirmation that you have complied with all the obligations under Income Tax Act. But if anybody else has different experience, you could probably share.
Thank you, sir.
Mr. Ramdas was saying something, Mr. Ramdas? Or anybody else who is experienced?
Yeah, so this is Ramakrishna. And can I ask a question that is in continuation to the Jaina, sir?
Can't hear you, sir. If you can repeat.
Yeah, so see, same cases of voluntary liquidation. If the voluntary liquidation is completed before the end of March, and there is a tax filing of tax site return requirement due to some tax obligation, and you got order also from NCLT. Still, do we need to file the IT return because IT total is not showing the assessment year 23-24?
It was the same question that Mr. Jaina was asking, and we just had a quick discussion on the same question. Yeah, I think some people are saying that NOC is not required. I'm completely with you that IBB has now put up a circular that NOC is not required. Correct, absolutely. NOC is not required. When you go for dissolution application, I don't know which NCLT are you actually facing, but my limited experience is that NCLTs asked you to give an affirmation that you've complied with all the obligations of income tax, including return of income also. So, but that's where we leave it. Maybe experience of different NCLTs might be different. Shikha, if maybe you can briefly talk about the GCS going concern sale. This is another interesting area. That's
Sir,
now
before that, I just want to ask simple question.
Yes, Mr.
During
Joshi.
the CRP, we found that the previous year's returns are pending. Okay, in CRP or liquidation, whether the RP required to submit this return?
Well, my answer would be yes. I don't know whether you would hate me saying that, but if there are some pending compliances and you come to know that there are pending compliances, you should take the effort, due effort to comply with this. To say that it was not, to say that it was not my burden, it was burden of earlier management, to say that it was their responsibility. If there are some pending compliances, I think logic demands that we need to complete them.
But sir, what if there is no records available with the IRP, RP or the liquidator for
The
previous
same case,
years?
record is not there, data is not available, and then 3-4 years ROC returns are pending, income tax returns are pending, even PF PSI returns are pending. So what?
I wouldn't be able to deal with PF returns in this particular session. That's beyond me. But as regards tax returns, I think saying books of accounts are not in place. I mean, we're talking about very difficult situations here, but to the extent, let me, I mean, modify myself by saying that to the extent possible, under given circumstances,
Only the bank statements we can avail from the public records, not any other document. Then how we can presume to comply with the provision?
During our accountancy course, we used to have a topic on this also, preparing financial statements from incomplete records. So I think we should try to use all our, I mean, intelligentsia, all our intellectual resources. The essence basically is that we need to make the entity compliant. If you keep it non-compliant, somewhere or the other, it would hit us. I think my submission is that pending non-compliances, no matter whose, at some stage will hit you. At some stage, there'll be an implication coming on you. There might probably be some notices, some penalty, something. So instead of facing embarrassment, if we try to complete pending non-compliances, I think that will be my submission. I know that under circumstances, sometimes it may not be possible, but to the extent possible, I would suggest we do it. Vikramji would like to say something.
So if you permit me, I'll just share a quick, experience in this regard, because in one of my assignments, 3 years books of accounts were not complete. The COC was insisting that the cost for maintaining the books of accounts for the prior period prior to CIRP is the cost of the promoters, and COC will not bear the cost. So ultimately, I filed an application in the NCLT. NCLT gave a very clear direction that COC cannot say that the cost has to be borne by the promoters. The COC will have to bear the cost, and the RP will have to maintain the books of accounts, complete all the compliances up to the CIRP date. So this point is very, very clear that all pending compliances has to be done by the RP.
Thanks, Vikramji, for making us wiser on this. I know we are wiser and sorry.
Unfortunately, sir.
The pains of being an insolvency professional are never ending. So I think we are all together in the pain.
It's only increasing, sir.
Right. The going concern sale, that's a very interesting topic, because here we're talking about saying that we are transferring the entity itself. In CRP as well, there's a transfer of entity. But here we're saying transferring a going concern as a part of liquidation. In CRP, what happens if there's a transfer of entity, the liabilities as provided by the resolution plan, the liabilities also travel to the acquirer. The acquirer settles the liabilities in the manner, of course, provided by resolution plan. But in a going concern sale, the uniqueness is that all liabilities would have already become claims against liquidation estate, and the transfer of the entity is done completely clean, in a completely clean manner. That would be no liabilities accompany the transfer of assets, because it's a manner of sale. As you sell assets, you are selling assets free of liabilities. Therefore, in a GCS sale, also you're trying to sell the undertaking free from all existing liabilities, which also means free from all existing tax liabilities. So if there are existing tax liabilities or whatever other liabilities in going concern sale, those liabilities become claim and they are settled in terms of priorities of section 53. And that part is clearly understood. Now, some acquirers of undertakings under a going concern sale have gone to NCLTs, different NCLTs, NCLT Hyderabad, NCLT Mumbai, and there are some very interesting rulings of some NCLTs, particularly the NCLT ruling in Mumbai NCLT in case of Topworth Pipes and Tubes Limited. The citation is there on screen. There's a more recent ruling in the case of Sterling Biotech. These rulings have gone to say that a GCS sale is similar to a sale during CRP, and therefore all the benefits which are eligible under CRP will be available in case of a going concern sale as well, which goes to actually say that if there is a benefit of carry forward of losses, that will also be available to an acquirer under a GCS sale. Now, while this might be little conflicting, because on one hand we say that a sale in liquidation is free from all liabilities, it's almost like a new avatar or new birth to the entity. It's a completely new avatar and new birth to the entity, which is actually getting a resurrection in the hands of the acquirer. The acquirer is buying the entity from liquidator. Acquirer is not acquiring the undertaking itself, it's buying the undertaking from the liquidator. And therefore, it's hard to think as to how the benefits of tax holidays or the benefits of carry forward of losses can be continued. But some NCLTs have even gone to say that even a tax holiday, which was applicable to the entity before liquidation, some are going to the extent of saying that appropriate tax reliefs, for example, benefit of carry forward, etc., also must be available. However, the NCLTs have gone also to say that the assessee must approach the tax authorities to avail such relief. Some NCLTs have gone to say that this is not my domain, I cannot help it. You must approach the tax authorities for appropriate relief. Sure enough, I'm sure that tax authorities will not be forthcoming. Tax authorities will go as per explicit provisions of law. In section 79, there's an explicit provision in the law. For GCS sale, there is no provision of law at all, because section 79 is explicitly talking about CRP. And therefore, there is no explicit provision at all. Therefore, these rulings of NCLTs, to what extent will they help? I do not know, but there are increasing number of rulings now saying that a GCS sale is akin to a sale in CRP. So that's the position about CRP transfers. We also would like to now discuss the write back of liabilities, which is, and before we come to voluntary liquidation.
The one small point on the GCS sale.
Yes, yes.
Is it possible to, give a kind of a plan under the GCS sale as in CIRP?
To my mind, I think question of plan does not arise here because it's a sale by liquidator. GCS sale is one of the ways of selling assets. Assets can be sold on slums.
But if the acquirer wants certain kind of reliefs, how would you obtain those reliefs?
Acquirers are making applications to NCLTs. Some like I mentioned, NCLTs are giving some reliefs also. Some NCLTs.
So those reliefs has to be applied by the liquidator, or how will it work actually?
It's, I mean, to best of my understanding, it's an application filed by the liquidator where the acquirer is also becomes a party, and the two of them go to NCLT. NCLT, sometimes NCLTs have been very generous. One can see the ruling of NCLT Mumbai in Topworth and the more recent ruling in Sterling Biotech. I'm sure there are other rulings also that I may not be aware of, but NCLTs have been quite liberal in granting several reliefs.
But can my reliefs be as a condition to my acquiring as a GCS sale?
But then supposing the NCLT does not grant the relief, then the sale becomes contingent. The sale fails.
So my basic point is that whatever reliefs I want, can I give those reliefs in writing to the liquidator? And can those reliefs be a part of the application of the liquidator to the NCLT? Now, if the NCLT doesn't allow those reliefs, then again, I'm into a different situation altogether.
So Vikramji can consider about this because the sale under GCS also happens through a auction process. In all sales in liquidation happen through an auction process.
Right.
In the auction process, the conditionalities of the sale are set by the liquidator.
Right.
Liquidator does not put a condition that XYG reliefs will be available to the buyer. Liquidator says, I am selling as is, where is, whatever is basis. This is what I have, and this is what I'm transferring. So if we agree to terms and conditions of the sale as per the auction put up by the liquidator, the buyer agrees and the buyer therefore bids for the auction, the buyer succeeds. Once the buyer has succeeded under an auction, it is not open for him to put conditions that say that I would buy it only if the following things are done. Because the very process of an auction will be vitiated if the auction buyer puts condition. There's nothing called conditional bid in an auction. Auction, I'm sure you can appreciate that in auction is a public sale. You're selling to public at large.
Right.
Whoever wants to bid can bid in auction. Therefore, the terms and conditions are open to everyone. No bidder can come and put his own condition because those were not part of the conditions set by the seller in the auction. So to my mind, the question of putting any conditionalities in a GCS sale, in my perception, is completely alien to the whole. Yeah, Shikha, just a moment. Completely alien to the concept of sale under GCS. Shikha would like to add up maybe.
Please.
Yes, sir. So number one, there cannot be a conditional bid. Yes, of course. But once the bid succeeds, then the successful bidder can always approach NCLT with the help of liquidator to seek such reliefs. But then again, as we saw in various rulings, even if NCLTs are granting reliefs, those are subject to approvals of competent authorities.
Correct.
So that again does not help the successful bidder much. But yes, that stamp from the NCLT saying that the principles of resolution should squarely apply to GCS sales, vagera, that those might be certain brownie points to take before the tax authorities. Just that point.
So, if you permit me, a related question to this point is, suppose in CIRP, I as a resolution applicant, I'm a successful resolution applicant, and I seek certain reliefs. Now the order says, you go to the appropriate authorities and seek the reliefs, and the court doesn't grant me those reliefs. So the problem is, as a successful RA, what is the recourse available to me?
If
the department will not give any relief, if I go to the department.
I think by now this is we see several matters where the NCLTs or NCLAT has increased the amount payable by the resolution applicant. I think one can talk about Jetaways as a famous case where the NCLAT required the resolution applicant to increase the amount payable itself. I guess Jetaways matter is probably in Supreme Court as of now, but I'm not too sure on that. But the fact that the resolution plan typically says that the resolution applicant adheres to the jurisdiction of the NCLT or NCLAT, and therefore whatever orders are given by NCLT or NCLAT will be binding on him. I think there probably one would say, but there was reliefs prayed for, the reliefs were not granted, and the RA cannot back out saying that because the reliefs were not granted, therefore my bid is cancelled now. I don't know whether that.
So sir, basically this is adding a lot of uncertainty to the whole process because the tax liabilities are so humongous, and if the department don't give any relief, NCLT is also not giving reliefs. So actually SRA, gets stuck with an approval of the plan.
Resolution plan, well, section 79 is very clear, and therefore there is a continuation of tax benefits. In a GCS sale, whether the tax liabilities or tax benefits of the undertaking will be available to a buyer, I have grave doubts because section 79 very clearly does not talk about GCS sale. NCLT is saying that the tax authorities may consider. कौन सा tax authority इतना liberal है जो law में grant नहीं है वो tax authority देगा. Law में जो granted है वो भी नहीं मिलता है. जो law में नहीं है वो देना. I think that's wishful thinking.
Absolutely.
So that is like simply giving a sense of feel good. You can probably feel good. NCLT ने मेरे को बोला है जाके you can probably process with the tax department, but nothing is going to come out of it in my view. And I think it also seems little logical because GCS sale, we are saying there is a sale of an undertaking free from all the past burdens and all the past benefits. So therefore that's my view. Mr. Dakshesh Shokshi, Dakshesh bhai.
Yes, sir. Sir, in case of GCS, whether GST and stamp duty would also be applicable?
Sale of undertaking, Dakshesh bhai. The undertaking itself, there's no question of transfer of assets. It's like sale of a company.
Right.
If it's a sale of a company, there's no question. In my perception, once again, there's no question of GST. There's no going concern anyway is exempt from GST.
Okay.
GST law has a exemption. CGST Act has an exemption. I think it's part of CGST itself. The schedule itself has a clear exemption for transfer of a going concern under GST law. Definition of going concern under GST law is a little different. There have been several rulings on what is a going concern sale. But if something qualifies as GCS sale in liquidation, I'm almost sure it will qualify as a going concern sale under GST laws. So GST, I think the matter is resolved by the explicit provisions of the GST law itself. As for stamp duty is payable on transfer of undertaking. Transfer of property. Conveyance of property. Stamp duty is mostly applicable on conveyance. So the question would therefore be, if you're transferring undertaking itself, does it amount to a sale of an undertaking, a sale of a conveyance? Now, if we apply the principles enunciated by courts in the matter of Hindustan Unilever Limited, before that the Bombay High Court ruling in Litaka Pharmaceuticals, etc., which are all matters dealing with amalgamation, courts have taken a view that even a consensual transfer of a going concern also may be liable to stamp duty. But here, I think one could normally the principle of stamp duty is that stamp duty is payable by the buyer. So you'd probably write in the sale deed that if at all stamp duty is payable, it will be the liability of the buyer.
Okay, thank you, sir.
To my understanding, I mean, unless you're transferring immovable property, people are not adhering to stamp, because you don't need to register a transfer of an immovable, a registered transfer of going concern sale. So people are not going ahead and subjecting themselves to stamp duty implication, because stamp duty itself will be used.
Yes, thank you.
Then what about liabilities? Because in case of going concern sale, we have seen some.
So, sir, all liabilities become claims. There's no question of liabilities going to the buyer. Where liabilities have become claims under liquidation estate, and those are settled in terms of Section 53. There's no question of the buyer being asked to settle the liabilities. Any sale under liquidation is free from liabilities. That is the basic principle of it.
Sir, in transfer under going concern, if there is a major portion is land and building, will not it amount to be a what you can say, stamp duty?
Avoidance device. So to prove it's going concern, if all that is there in the undertaking is merely a bunch of assets, then the question will be, is it a going concern at all? Going concern means the concern must be going. That would mean it must be a running business. I think recently only there was some ruling defining what is a going concern. What is a going concern? There must be evidence that the undertaking is still alive. It's not dead. Which means, see, in CRP, there's a presumption that the undertaking is going. That's the whole meaning of CRP. The undertaking can be revived. The moment the undertaking slips into liquidation, by definition, it ceases to be going. It becomes a gone concern. But liquidator, if it realizes that the undertaking is going and that the value will be maximized by transferring the undertaking as a going concern, then he may make due efforts to keep the undertaking as a going concern. So it has to be, I would say, established by the liquidator that there was activity going on. The undertaking was preserved as a going concern with a view to maximize value realization. And it's because of that what was transferred was not merely a bunch of assets, but was a going concern.
Sir, it is simply transfer of shares. I have sold one corporate debtor as a going concern under liquidation. I just issued shares to the buyer and extinguished all the present shares. In this way, I have done the liquidation of the company by selling as a going concern.
Right, Mr.
So when shares are transferred, then, sir, where is the question of stamp duty?
That's exactly what I was mentioning, Mr. Jana, that since we're not going for registration of transfer, just a moment, sir, let me just finish. We're not going for registration of transfer of any asset or property. Question of stamp duty comes when you go for registration of a conveyance. We are not doing that here. Therefore, there's no question. Usually there shouldn't be a question of stamp duty, though Mr. Jena, your practice of issuing or allotting or transferring shares, that's something that I am unable to comment as of now. But well, since it's a case of transfer of undertaking, the normal process would be that the buyer should be able to convert the value that he pays for acquisition of undertaking into shares or liability as per the choice of the buyer. Whether the amount that he pays is share capital, the amount that he pays is debt. Like in case of resolution plans, partly it comes by way of shares, partly it comes by way of debt also. So that option should be available to the buyer of the concern. But Mr. Jana, your point about issue of shares in consideration of the money that the buyer pays, that is still one of the possible ways. There was somebody else, Mr. Manish Jain has raised hand. Mr. Ranjan Chakravarti, sir.
Yes, sir. My question.
Yes, sir.
Let Mr. Ranjan Chakravarti finish first, Manish ji, thereafter maybe.
Okay.
It was mentioned on sale as a going concern in liquidation, as is where basis. It is usually written there in the auction document. And in that case, AT also has said that in this case, liability would also have to be transferred to the transferee, because it was written in that as is where basis.
If we think of a GCS sale in liquidation resulting into shifting of liabilities as well, then section 53 will lose its meaning altogether. Let's not forget that GCS sale is, after all, sale as a part of liquid. It's a manner of sale, mode of selling assets. It comes under the provision of liquidation regulations, which deals with sale of assets. Assets can be sold by liquidator in various ways, including GCS sale. So GCS sale is nothing but a sale of assets by the liquidator. If assets are being sold by liquidator, question of liability is going to buyer does not arise, because the buyer has to pay for the liabilities. Then section 53 loses its meaning. Then the liability holder has a full priority against the buyer. So the whole concept of section 53 will lose its meaning in my perception. So
in that case, I think most probably is pinning on this sale of undertaking on as is where basis. So
right.
As is where basis, that means that sale of undertaking along with its assets and liabilities also. So
that is, at the first impression, that's the impression anyone gets, that after all, if the undertaking itself is going, the liabilities will also go. Like in case of amalgamation, for example. In case of amalgamation, what goes? Assets and liabilities both go. Undertaking gets transferred. Slum sale, for example, undertaking along with liabilities. GCS is a unique case where transfer of assets goes, undertaking goes, assets go, but no liabilities. Liabilities become claims. That should be clear. I think jurisprudence on GCS sale is still developing. Rulings are still coming before courts. Matters also before.
Sir, if it will be written in the auction document that sale of assets as one basis, so in that case, stamp duty may be invoked.
The question of stamp duty is still an open question. I did say that while practically we don't need to go for stamp duty because we're not going for registration of conveyance. But in case of amalgamation also, for a long time, people were not paying stamp duty, years back, until the rulings of Bombay High Court first and then Supreme Court came, that even a transfer of assets in a scheme of amalgamation is also liable to stamp duty. So maybe at some point of time in future, the question of stamp duty on a GCS sale and liquidation may once again be rigged up. But as a liquidator, you are probably trying to get relief by stating in your sale deed that stamp duty, as and when applicable, or if at all applicable, along with attendant interest or penalties or whatever, shall be the liability of the buyer. So probably saying, well, if it is there, let the buyer pay. And let's hear Mr. Manish Jain.
Yes, sir. If in DCS, whether if there are any license and permission will also be transferred to the buyer?
So Manishji, that's the whole purpose of a GCS sale. When the whole purpose of GCS sale as opposed to slum sale is preservation of contractual rights of the corporate debtor. Very often the value of a business comes from contractual rights. For example, a concession agreement, a license agreement, a lease agreement, any kind of an entitlement. So the whole purpose of a GCS sale is that we are not destroying those soft contractual assets. So to my mind, that's the whole purpose. And as you're writing in the sale deed, along with contracts, intangible assets, etc., I think one would very clearly define what is it that you're trying to transfer in GCS sale. But my view is that all contractual entitlements, all licenses or contractual entitlements will be preserved in a GCS sale. That's the whole intent in mind. We have had a substantial interest from participants on GCS sale. Mr. Praveen Navandar, sir, you'll be the final person on this. Then we'll have to move to.
One of the question now, see, under resolution process also, there
Yes.
are different units sale available to the RP. See, if the company has a 10 different manufacturing unit, I can go and after the sales fail for the 10 unit, the resolution professional puts up the unit wise sale or project wise sale in a real estate company. Suppose if I buy a unit under the CRP under the resolution process, so how the transfer will take place? Transfer will take place as a slum sale or as a going concern sale?
It may be, yeah, so-called slum sale or BTA.
Or is a part of a resolution process and demerger, how the things will move?
Demerger is also possible. Now the IBC will probably contain a provision for split resolutions also, partial resolutions as well. That's one of the proposals maybe in the forthcoming insolvency amendments in the monsoon session. We'll probably see a concept of a partial resolution without waiting for the entire business to be resolved. Different units or different things may be resolved before the entire resolution takes place. But until that amendment comes, it's definitely possible to do slum sale. There's no doubt on that. Slum sale as a part of resolution process is quite okay. Demerger is also possible.
Nick, but then what will the implication under the, see, if I go for an entire company, I will get directly issue the shares. If I go for a partial sale or one of the unit sale, I will have to do slum sale. In that all this stamp duty and GST and all this will come into picture. Stamp duty will definitely come into picture, if not GST.
In a BTA, normally the implication is that of stamp duty. GST is not there because, like I mentioned, GST has an exemption for a going concern sale. Stamp duty, however, would be applicable, and stamp duty is the cost of the buyer. So normally the buyer has to take care of it.
Yeah.
Demerger is
when
not
we are advising buyer, it is our cost.
I completely understand. Demerger is not a remedy. Demerger, while it's possible, but that's not an appropriate remedy, because in case of demerger, the consideration will be payable to the shareholders. That's not our idea. Our idea is not to get the benefits transferred to shareholders. The idea is to get the benefit in the company itself so that we can distribute it to creditors. So demerger mostly doesn't work in a CRP sale.
Okay.
Right.
Fine.
So moving back to the consequence of write back of, this is a very important point. And while in section 115 JBA or JB, there is a amendment specifically, but in terms of section 41 and in terms of section 28/4, there is still not enough clarity. Now there is a write back of liability. There's a what you call haircut or write back of liability. That's invariably part of every resolution. We write back liabilities. We write back the liabilities to financial creditors. In the context of financial creditors, it's possible to say that the write back of liabilities is not taxable in terms of section 41, because section 41 talks about a trading liability. One can see the word uses in respect of a trading liability. The simple meaning of trading liability is liabilities which were claimed as expenses in the past, liabilities which might have resulted from claiming an expense in the past. Now, sure enough, the borrowings, in case of working capital loans, it's still possible to argue that the borrowing also was at some stage claimed as an expense. But it's not the borrowing which is claimed as an expense. It's an expense which leads to utilization of working capital. There's a difference between claiming the expense as an expense and funding the expense by using working capital. So it might be possible to argue that as far as the haircuts to FCs, financial creditors, are concerned, they are not hit by section 41, as section 41 talks about only a write back of a trading liability. But when it comes to write back of operational creditors, that's a huge amount of money payable to operational creditors, which invariably gets a haircut in resolution process. There, it seems that one cannot escape Section 41, which is very clearly applicable here. Or if Section 41 does not apply, then by a stretch of argument, even Section 28/4, which talks about value of any benefit, perquisite, etc., arising from business or profession, that also may be brought in. But I think specifically Section 41 might still remain applicable. So as there is no exception under Section 41 to a CIRP, the issue basically would be that if at all the tax officer intends to tax the write back of liabilities as an income under Section 41, then the only benefit that we have is the benefit of set off and carry forward of losses. So it's very important, and this is a point that I made earlier as well, that it's very important to ensure that we have a continued filing of returns of taxes, because if returns of taxes have not been filed, then the benefit of carry forward and set off will be lost. It might be lost forever. So it would be important to ensure that there is a carry forward benefit. The resolution applicant would try to ensure that there is a valid carry forward right available, because there may very surely be a question of write back of liabilities in terms of Section 41. Now, I'm aware that some resolution applicants are using another device for avoiding Section 41 applicability by saying that the liabilities will first be converted to capital and then they will be reduced by way of reduction of capital under the same scheme. That is, instantly the liabilities become part of share capital and the share capital automatically gets reduced, so that there is no filing required for allotment of shares or for reduction of capital as well. I do not actually understand as to how this argument of issuing shares to operational creditors and writing them off, how will that be actually helping? Because it's for sure that it results into a write back of liability. And logically, these were the very liabilities which in the past might have been claimed as expenses. So if expenses were claimed in the past, the expenses were not probably fully set off. They're continuing as income, as let's say, continuing as losses. And therefore, appropriately, the acquirer should be aiming at claiming the set off of past losses to neutralize any tax liability on account of Section 41. So I think that is the only way one can escape any unpleasant tax consequence of a write back of operational creditors. The last point that we have today, and I'm aware that we already have exhausted the 2-hour time that was given to us, is the procedural part. Section 115 JB, by the way, Shikha has very clearly brought us on Section 115 JB. That's the tax on minimum alternative tax. And there again, as we write back the liability, there might be a credit entry in the P&L account. You might get a credit entry in P&L account because you're writing back the liabilities. There explicitly, amendment was brought to say that while you're writing back the liabilities, the eligibility to claim the benefit of past set-off, past losses will be available by virtue of the specific insertion of Roman 2H in Section 115 JB. So this part is anyway coming clear, that while the write back of liability will not be leading to a benefit, will not be leading to tax on account of book profits, because you can then avail the past brought forward losses. That point has been made clear by 115 JB, but there is no corresponding change in Section 41. Now, moving to the procedural part of filing of returns of income, etc. This is the last procedural part. We can very quickly go through that. Voluntary liquidation, I guess there are no separate specific issues. Shikha, you can go to the procedural part, yes, straight. So as far as TDS is concerned, wherever deduction of tax at source is applicable, TDS or TCS, as an IP, we need to still comply with the same. We need to file returns of income because we are now treated as the authorized signatory, and the obligation of filing returns of income is on the IP. All obligations for filing returns in time would still be there. As far as tax audit requirement is concerned, I think in case of liquidation, one can argue that there is no business being carried forward now because the business has stopped. So one might argue that tax audit is not applicable, but during CIRP, even that obligation still continues. So all procedural tax compliances will be applicable. As everyone is aware, Section 178 requires the liquidator to provide notice to tax authorities within 3 months of initiation of liquidation. And I think that's about it when it comes to the procedural part. I think with this, let's maybe open up for any remaining questions from participants, but you all have been so very interactive all through, and it's been really very interesting to interact with all of you. But whatever pending questions that Mr. Neeraj Parmar and I think Mr. Praveen Nawandar also has put up some, and Manish, whichever order. Yeah, maybe this Neeraj Parmar first. Neeraj ji.
Yes, actually, what I was having one assignment regarding voluntary liquidation, where I have intimated the authorities regarding commencement and appointment of liquidator. However, the income tax authority has initiated the assessment and TP proceedings before initiation of liquidation. So we have intimated the authorities and requested several times to either to conclude the proceedings or to give their claims or queries with us. However, we still the period of liquidation has been concluded, but still we did not receive any kind of correspondence from it. So I have a question whether I need to obtain NOC from department regarding the proceeding status still going on, and if because I've only left with the repatriation of funds and NCLT petition. So once the proceedings will be concluded, I can proceed with the repatriation NCLT petition. But due to the proceedings, I have to continue the voluntary liquidation for another period of 12 months.
So Neeraj ji, this is something that I think everyone who is handling voluntary liquidation will probably be facing. There are some pending tax refunds. Assuming the corporate debtor has some pending tax refunds, refunds take long time to come. Pending appeals, pending refunds, pending assessment proceedings, that's a pain in life. You can't help it. So until the proceedings are completed and the refunds or demands are completed, to my mind, even if you file liquidation dissolution application, the NCLT will still ask you to ensure that all proceedings are completed. This is more so in case of pending refund, because their refund might take long time. It might take years to come.
So, sir, is there any other remedy that we can approach to IBBI for any kind of
change up the tax officer to see it's IBBI cannot help it, NCLT can neither help. So it's basically your effective communication.
Hello.
Manish,
during liquidation, if we go for the restructuring under section 230 and 232, like reverse merger or merger, what will be the tax aspect?
As well, during liquidation, you go for section 230. However, the tax implications of a merger, reverse merger will still be the same as in case of any other amalgamation. So the provisions of section 72A read with the definitions of amalgamation or demerger will equally be applicable during liquidation as well. There is no separate section 72A does not have any separate provision dealing with either an amalgamation during CRP or amalgamation as a part of liquidation process, for that matter demerger as well. So same provisions will be applicable. That would mean the of forward and set off will be available to the transferring entity only if demerger 72/4.
I have one question.
Madam.
I have one question. If I have not received the password for the income tax portal of that corporate debtor in CRP, how do I generate that? Is there any solution to this? Because I have to file TDS returns also.
I don't have any clue. Sorry, I don't have any clue. I think chartered accountants and practice might be able to help, probably. I don't have a clue, sorry. I don't think we face this issue. So I may not have an answer because we have faced this problem. This is the only problem we have not faced.
If it is TDS returns can now be filed after a gap.
There are people who have answers. Ranjanji.
Yes, I have filed in case of one of my assignment, the TDS returns were long pending, and I had filed that as I paid some professionals, I had filed TDS returns. After that gap had been, they are now allowed. Income Tax Department is now allowed TDS returns to be filed after gap.
Mr. Chakravarti, thank you very much for helping us out. I think it's time for us to conclude and refer back to ICC IPA for the concluding remarks from my side. And I'm sure my colleague Shikha will also say the same thing, that we have today 250 participants continuing for last 2 hours. And that's remarkable. Thank you very much for so very kindly, generously joining us today for this very complicated topic. I'm wondering to what extent we've been able to help you, but it was an interesting deliberation for both of us. We emerged a lot articulated, lot benefited by your interactions. Shikha, to say something before we...
Can we share PPT, sir?
Yeah, that's not a problem.
Kindly share
Not a
the
problem.
PPT, sir.
Yes,
Sure,
we will
sure.
share
We'll
it
be
with...
sharing the same with IPA and IPA.
Yeah, we'll share the same with the participants.
It's a very
So,
valuable information, and we don't
Yes.
have any information like this.
Thank you very much. Thank you very
IPs don't have. Please
Thanks,
send the information, sir. Thank you.
I would like to
Thanks a
thank
lot.
all the participants for joining us and being so active for the last 2 hours. As sir said, like almost more than 250 participants were active throughout the session, which rarely happens. And the participation was also quite a lot. And sir and Shikha, thank you very, very much for joining us and for taking up this session. I'm sure it was very, very helpful. All the participants have had great insight through this session, and it's a very complicated topic, and I'm sure it wasn't easy to sum it up all in 2 hours, but I'm sure the participants have learned a lot, and as always, it's been a great pleasure having you with us. Thank you so much, sir. Thank you so much, Shikha, for
Thank you so much, and
for this
all the
wonderful,
Thanks for the
wonderful
opportunity.
session.
Thanks.
Thank you so much.
Thank you.
Thank you.